If you're a real estate investor anywhere in the world, your feeds are probably flooded with headlines about Dubai. It's impossible to ignore, because in 2025, Dubai isn't just breaking records, it is fundamentally rewriting the rulebook for global real estate. We're talking everything from off-plan projects selling out in hours to billion-dirham villas redefining what ultra-luxury actually means. And the way international investors are pouring in money, that's what we need to break down. Hey everyone, and welcome back to the Terra Dubai Property Report. I'm your host, Scarlett Reed, and I'm so glad you could join me today. We are diving deep into the trends that matter most if your goal is to invest smart, and more importantly, invest strategically in Dubai. Let's start with the big one, the off-plan boom that has truly taken over the market. Look, just in Q3 of this year, off-plan transactions accounted for a staggering 70% of total sales volume. That is the highest share we have seen in 3 years. As a broker here with Terra Real Estate for years, I can tell you exactly what's driving this. It's 3 things: flexible payment plans, genuine investor confidence, and frankly, the market knows the government is backing this growth all the way. Investors want to lock in today's price in a prime location with only 20 or 30% down, and then they want to ride that capital appreciation until handover, a couple of years from now. That is financial leverage at its best. A word of caution here, though. If you are chasing off plan, you cannot just buy from anyone. The biggest risk is a developer failing to deliver on time or on quality. Our number one advice at Terra is to stick only to developers who have a proven track record of delivery, especially in areas like Dubai South or the new coastal master plans. The sheer liquidity pouring into the apartment segment, notably in areas like JVC and Business Bay, is unprecedented, proving that demand is still outpacing supply in those early-stage launches. But while off-plan is dominating the sheer volume of transactions, the luxury market is quietly setting a different kind of record. When we talk about luxury, we mean the AED 10 million and up crowd, and here the momentum isn't slowing. It's just getting more mature and exclusive. We saw over 730 property transactions priced at AED 15 million and above just in Q3. These aren't short-term flippers, these are high-net-worth individuals, UHNWIs, securing their wealth. They're buying into Palm Jumeirah, Emirates Hills, and Jumeirah Bay Island for 3 things: safety, lifestyle, and global prestige. The biggest value driver in this segment is the branded residence. Think Address, Six Senses, Bulgari, or Bugatti. These properties command a massive premium, up to 40% higher than non-branded units, but investors are happy to pay it. Why? Because you aren't just buying an apartment, you're buying a managed, 5-star lifestyle asset. It offers superior rental yields, and critically, it holds long-term value because the brand guarantees quality and service. This trend is fueled by global wealth migration. They're using the golden visa to secure long-term residency, and then they're parking their capital in an exclusive asset that is protected by world-class safety and a tax-friendly structure. They're securing a lifestyle that holds long-term value. So, we have this massive momentum in both off-plan volume and luxury value. But the real question every investor is asking, and the reason we are recording this today is, how long can this momentum last, and where should you be positioning your portfolio for 2026 and beyond? That's what we tackle right after the break. Stay tuned, because next, we dive into the 2026 supply surge and reveal Terra's strategy for navigating it. Now, let's first tackle that elephant in the room that every smart investor is quietly talking about: the supply numbers. We just talked about record sales, but that confidence has led to record construction. The forecast is significant. We're looking at potentially over 200,000 new units hitting the market between now and 2027, with 2026 being the peak year for handovers. And look, if you're investing in any other major global city, London, Sydney, Toronto, that number would be a near guarantee of a market crash. prices would plummet. But Dubai is different. The real question isn't if the supply is coming, it's where it's going to hit and how it's going to be absorbed. As your expert at Terra Real Estate, I want you to understand that the market is officially bifurcating. It's splitting into two distinct parts. On one side, you have the mid-market apartment segments. This is where you might see some temporary price correction. Maybe a 10 to 15% softening in rental yields and capital values in specific buildings or areas that receive a huge volume of similar, generic apartments. This is the risk you need to avoid. But on the other side, you have the prime, luxury, and branded segments. These are insulated. They're being bought by UHNWIs who are moving here, securing golden visas, and creating genuine, long-term end-user demand. They're not going to compromise on quality just because there's an extra apartment complex down the street. This is why we need a strategy. We can't just throw money at the market. We recommend a strategic split right now, the 60-40 hedge. 60% of your portfolio should be your defensive play, yield focus. This means investing in ready properties or high cash flow off-plan units in established areas like DIP or JVC. These are your workhorses. They generate immediate, high rental yields, often 6 to 8% net, that cover your financing costs and make your portfolio recession-resistant. The remaining 40% is your offensive play, appreciation focus. This is where you chase that exponential growth. You must look for scarcity, exclusivity, and government vision. That means branded residences, because the quality is guaranteed. It means waterfront luxury, because they can't build any more coastline. And it means master plans with massive government backing. This strategy is about mitigating the supply risk while still capturing the incredible growth Dubai offers. So if you want to play offense and get maximum appreciation, you have to choose quality over quantity. And that brings us perfectly to our next segment: how investors are using the golden visa not just for residency, but as a financial tool to drive those huge appreciation numbers. Now let's talk about the offensive play and the who that is driving those massive appreciation numbers. The global investor using Dubai as a clever financial tool. I'm talking, of course, about the golden visa. For international investors, this isn't just a residency perk. It's a financial leverage tool. The threshold is clear. An investment of $2 million a year in property secures you and your family a 10-year residency visa. But here's the magic. Most smart investors aren't paying that entire 2 million dirhams up front. They're using off-plan payment plans. Think about the financial arbitrage here. Let's say you find a 2 million dirham off-plan apartment in a prime area like Dubai Creek Harbor. The developer's payment plan might be 40% during construction and 60% upon handover in 3 years. You only invest that initial 40% cash, which is just 800,000 dirhams, to secure the asset. But you're eligible for the golden visa immediately because the total value of the asset is $2 million. You've secured your 10-year residency for less than half the capital. Now let's say that property, thanks to the completion of infrastructure and market maturity, appreciates by a conservative 20% by handover. That's 400,000 dirhams gain on a 2 million dirham property. But your ROI on invested capital, the 800,000 dirhams you actually put down, isn't 20%. It's 50%. This is the financial arbitrage we help clients execute at Terra Real Estate. We call it the appreciation play. You're maximizing your capital exposure to appreciation while minimizing your capital outlay, all while securing a 10-year residency visa. This is why the off-plan market remains so hot at the luxury level. Investors aren't chasing rent checks on these deals. They're chasing that huge, tax-free capital gain upon handover, or shortly after. Our value here at Terra is guiding you to the units that have the best off-plan payment plans and, critically, have the highest potential for that appreciation. Not all off-plan is created equal. We look at the developer's historical performance. Have their last 5 projects delivered a 20 to 30% appreciation on invested cash? That's the data that matters. So you secure the visa, you leverage your capital, and you set yourself up for an enormous tax-free gain. It's a compelling financial case, but this strategy relies on one key thing: betting on the right asset in the right future master plan. And that brings us to the ultimate strategic question: where exactly do you place that future-proof capital? We've talked about the risk, the supply surge, and the reward, the golden visa arbitrage. But both of those strategies hinge on one thing: betting on the right master plan. If you are committing capital to off-plan, you are essentially betting on the future. You have to ask yourself, which asset aligns with the government's 2040 vision for Dubai? That vision is the ultimate guarantee of infrastructure, population growth, and sustained value. To help you with the 40% appreciation-focused segment of your portfolio, we are going to compare the 2 biggest future assets that have been completely reshaping the luxury narrative: Palm Jebel Ali versus Dubai Islands. First, let's look at Palm Jebel Ali. This is the scarcity play. It is the ultra-luxury capital preservation asset. When it comes to real estate, nothing commands more prestige and value than the Palm name, and the chance to secure a massive waterfront villa plot in this new development is drawing global billionaire capital. Palm Jebel Ali is about exclusivity. It's about creating the next global billionaires' row. The value is driven by the pure rarity of the land and the luxury mandate from the top. If you are looking for the absolute safest, long-term haven for generational wealth, where you know future pricing will be dictated by global HNW competition, PJAI is the clear choice. Now, let's compare that to Dubai Islands. Dubai Islands is different. This is the integrated living play. Think of it as a huge, diversified luxury hub. It's an archipelago of 5 smaller islands right next to Terra and the airport, making it incredibly accessible and integrated into the rest of Dubai's economic structure. The value here is driven by the sheer volume and diversity of high-end inventory. You have hotels, resorts, marinas, and various types of residential units, from luxury apartments to townhouses. It's not just for the mega-billionaire. It's for the highly successful executive and entrepreneur. So, as your real estate specialist, who wins? The answer, as always, depends on your goal. If you are focused purely on capital preservation and legacy wealth, betting on the continuation of the ultra-prime trend, Palm Jebel Ali is the winner. You are betting on the highest possible price ceiling. However, if your goal is diversified luxury appreciation and high rental liquidity fueled by tourism and business, because of the project's accessibility and proximity to the main airport, then Dubai Islands offers a more robust, diversified opportunity. My final actionable tip in this segment is: always check the developer's delivery timeline and RERA escrow status before committing to either. These are massive projects, and quality assurance is everything. Betting on these master plans is the ultimate way to future-proof your capital against any short-term supply fluctuations. Next, we are going to synthesize everything we've talked about into a final strategic outlook for the next 18 months. Don't go anywhere. We've gone from the excitement of the off-plan boom to the fear of the supply surge, and we've built the case for the golden visa arbitrage. Now, let's zoom out and synthesize everything we've talked about. What does this mean for your decision-making timeline in late 2025 and early 2026? My forecast is this: the market is not heading for a crash, but it is entering a period of necessary sophistication. The massive macro drivers that support Dubai are not going away. Population growth, massive infrastructure expansion, and continuous economic diversification will keep demand healthy over the long term. These factors overwhelm any short-term supply blips. However, the days of buying any off-plan unit and expecting a guaranteed 40% flip are over. The sheer volume of inventory forces a shift in the investor's mindset. You have to move completely away from short-term speculation and fully embrace asset preservation and strategic yield. This is why your investment choices need to align with Dubai's long-term master plan, not just the trend of the moment. Here is my final strategic insight for you. The value you secure today will depend entirely on quality. Don't buy a generic unit simply because the price is low. Buy the best unit in the best building, in a community that has a clear future vision, like the master plans we discussed. If you are buying for yield, the 60% defensive play, demand an audited rental history, and focus on communities with low service fees that protect your net ROI. If you are buying for appreciation, the 40% offensive play, focus on scarcity. Choose branded residences where the demand comes from a global, inelastic pool of wealth. This period of high delivery is actually giving smart investors, like you, a momentary window of leverage. You can demand better payment plans and negotiate for premium units that were unavailable a year ago. This is where strategy matters. It's what separates the investors from the speculators. And that brings us to the most important part of the episode, executing this plan. All right, we have covered a lot of ground today, from the 70% off-plan boom to the 2026 supply surge, and the absolute necessity of using the golden visa as a financial leverage tool. So let's quickly summarize the single most important takeaway from this entire episode. The Dubai market is not a bubble. It requires a surgical strategy focused on quality and vision. You must embrace the 60-40 hedge, using stable yields to protect your capital and strategic off-plan assets to chase that massive appreciation. And you must future-proof your investment by aligning with the government's 2040 master plans, whether that means the ultimate scarcity of Palm Jebel Ali or the integrated luxury of Dubai Islands. This is the moment to be surgical. The high volume of deliveries in 2026 is actually a massive opportunity to secure premium assets at maximum value, but only if you have the right analysis and access. That's where we come in. At Terra Real Estate, our team doesn't just look at market headlines. We work with proprietary data to develop a customized strategy just for you. We provide access to exclusive pre-launch luxury listings and the data-driven analysis required to execute the 60-40 strategy flawlessly. Don't let the supply surge scare you. Let us help you turn it into a leverage opportunity. We want to help you secure your high-performing Dubai asset before that next major cycle begins. To take the next step, simply tap the link in the show notes to book your private, confidential 2026 portfolio strategy session with one of our specialized brokers. Let us build your custom investment playbook. Thank you so much for joining me on the Terra Dubai Property Report. I'm your host, Scarlett Reed, and I'll catch you next time. Happy investing.